Okay, we'll kick off. Apologies for the heat. It should actually cool down in here fairly quickly because we have now just switched the air conditioning on. Why on earth I forgot to do that earlier, I don't know, so apologies. It's very good to see everyone here. We're very, very fortunate today to have Greene come and speak to us. Megan was appointed to the Monetary Policy Committee of the Bank of England 2 years ago. Has a year to run in your first term. I think it'll be a second, hopefully. Megan is a senior fellow at the Watson Institute for International and Public Affairs at Brown University and also teaches at the London Business School. She serves on the academic advisory board of the San Francisco Fed and is a senior fellow in global macroeconomics at Chatham House here in London. She's also an advisory board member of Rebuilding Macroeconomics and Econeffect, and a member of the Council on Foreign Relations and the Bretton Woods Committee. Prior to her appointment, Ms. Greene was the global chief economist at Kroll, a business services and risk mitigation firm, and also contributing editor and regular columnist at the Financial Times, writing on global macroeconomics and policy. In addition, she served on the International Advisory Committee of the board of the Hong Kong Stock Exchange, and has previously served as a senior fellow at the Mosavar Rahmani Center for Business and Government at the Harvard Kennedy School. She holds a BA from Princeton University and an MSc from Nuffield College here in Oxford. Today, Ms. Greene is going to talk about the Bank of England's balance sheet and how balance sheet management matters for monetary policy. Now, that may sound quite esoteric, but believe you me, it isn't. It's the center of everything that a central bank is its balance sheet. So really understanding how balance sheet management affects the thing we all know about, or at least we think we know about, monetary policy, seems like a topic well worth listening to. And I can't think of a better person to tell us all about that. So Megan, over to you.
Great. Can you guys hear me? Is this on-ish? Okay. Great. Thanks for that introduction, Stephen. And thanks to Nisar for hosting my speech. I've actually spent a lot of hours in this specifically, but also in other rooms, partly in my previous life as a market participant where I actually met some of you. We would meet up regularly to have discussions about what was happening in the world. And also as a board member of Rebuilding Macroeconomics, which used to be based here. So it's really nice to be back in this setting, and I appreciate the open setting that Nisar always provides for open discussion, hopefully including off the back of my speech. Social scientists really like to talk about structural changes, and my speech today is really no exception. I'm going to use it to explore one of the most important and often overlooked changes happening in macroeconomic policy at the moment, which is the shift of central bank balance sheets towards new steady states. And I'm going to look at what this means for monetary policy specifically. The former head of markets at the Bank of England said that the size and composition of central bank balance sheets can provoke passionate reactions, which might surprise you, given it might seem like an esoteric topic, but balance sheets are crucial in the role that central banks play in the functioning of our financial system and our economy. And given how dramatically central bank balance sheets have changed over the last decade, I think it warrants some attention. During the global financial crisis, as this audience will know, rates fell to their effective lower bounds. Many central banks had to turn to unconventional policy tools, such as quantitative easing, to stimulate lending and spending in the economy in order to meet their inflation targets. This resulted in a huge expansion of many central bank balance sheets. Additional subsequent shocks like COVID prompted further rounds of asset purchases over the following decade, leaving the size of balance sheets globally, central bank balance sheets at historically elevated levels. Following COVID, most major central banks began to slowly shrink their balance sheets in a process known as quantitative tightening. And you can see the evolution of three central bank balance sheets in this chart here, looking at the Bank of England in purple, the ECB and the Fed. So central banks increase their balance sheets, have subsequently started to decrease them, but how they've undergone the transition towards smaller balance sheets, what the end states will look like, and what facilities are used to support interest rate control and financial stability is not uniform across central banks. I'd like to spend some time today exploring some of these differences. First, I am to talk through the theory behind different end states and why many different paths can lead to the same destination. Next, I'll review what central banks have actually been doing, focusing on the Bank of England, the ECB, and the Federal Reserve. To be clear, this is not an exhaustive list of central banks undergoing this transition, but I've chosen these 3 central banks because of their impact on the UK economy. And then finally, I'd like to ask whether there are any pricing differentials that create trading opportunities for commercial banks, given the differences in how the Bank of England, the ECB, and the Fed are managing their balance sheets. To be clear, I'm looking at all this purely through the lens of monetary policy implementation. Do financial arbitrage opportunities impact central banks' abilities to implement monetary policy? When I refer to arbitrage today, I do not mean the academic economic definition that is a risk-free trade. I'm referring to financial arbitrage, so banks taking profits from trading opportunities. At the Bank of England, the day-to-day management of the balance sheet actually lies with the bank's executive, not with the MPC. But our remit on the MPC is to set monetary policy to maintain price stability, and subject to that, to support the economic policy of His Majesty's government, including its objectives for growth and employment. That requires having sufficient control of instruments impacting monetary conditions, which I'll refer to as rate control. These will be impacted by, among other things, developments in our balance sheet and international spillovers. My main message today is that different end states for central bank balance sheets may, at face value, create financial arbitrage opportunities for banks, but they're fairly limited. Financial arbitrage opportunities present incentives for banks to participate in our facilities, enhancing rather than undermining our ability to maintain rate control. This is a feature, not a bug. Now that I've given away my thesis statement, let me walk you through some of the theory behind central bank balance sheet frameworks. There's an exhaustive body of literature dealing with the theory underpinning monetary policy frameworks. But don't worry, I'm not going to take you through all of it. I'm going to focus on some work done by Annette Vissing-Jorgensen from the Fed. Her work helps to illustrate not only what options are available to central banks for their steady state balance sheet frameworks, but also why these different frameworks can all actually work. The starting point here is understanding the role that central bank reserves play in the financial system. Reserves are deposits that commercial banks hold at the central bank. They're considered the most liquid form of money. They act as the ultimate means of settlement for transactions in the economy, and they're only created by the central bank. There are 3 main reasons commercial banks would want and need to hold reserves. First, banks are mandated to hold a certain amount of liquid assets, known as high-quality liquid assets, or HQLA, of which central bank reserves are one form, to ensure that they can meet the payment obligations created by their customers at all times. Second, banks may choose to hold additional reserves to meet their higher than expected demand, including outflows in periods of stress. Third, banks might wish to hold additional reserves in excess of their precautionary needs or lend them to other banks if these options are financially attractive. We can formalize all these options in a general and simplified way using the economist's favorite tool, the supply and demand diagram. You can see that in this chart here. This figure is not meant to represent any central bank's balance sheet, to be clear. It's just a stylized example. The starting assumption here is that the supply of reserves and the interest paid on reserves are both set exogenously by the central bank. Supply is therefore fixed and unaffected by the interest rate in this stylized framework. You can see that here in the straight vertical orange lines. An expansion of the supply of reserves is demonstrated by an outward shift in the supply curve, for instance, from supply 1 on the left to supply 2 on the right, and a reduction in supply is represented by a movement in the opposite direction. The demand curve, which you can see here in aqua, illustrates the amount of reserves demanded by commercial banks at any given interest rate. The short-term market interest rate is determined by the intersection of supply and demand. There are a couple things to note about this aqua demand curve. First, it's influenced by the level of interest on reserves. Any change in interest on reserves, or IOR as I'll call it, leads to a vertical shift in the demand curve. As IOR increases, reserves become more attractive as a store of value, so the whole demand curve shifts up. It's also worth noting that the spread between the IOR and the market interest rate matters, since it impacts the opportunity cost of holding reserves and influences how many banks choose to hold. Second, the demand curve is downward sloping in nature, as is usually the case for goods, services, other assets. As their price or their market rate falls, banks demand more of them. But there are two more specific reasons for this downward sloping demand curve. First, as banks hold more reserves, the convenience benefits they get from holding extra reserves, notably that they're more convenient than monetizing other less liquid assets, diminishes, so they're willing to pay less of a so-called convenience yield for them. Second, as market rates go up relative to IOR, banks face a higher opportunity cost. Banks benefit more from lending out funds to other banks or using them to invest in other assets, rather than holding on to them in the form of reserves and earning IOR. A final note on the demand curve is it's not straight, it's nonlinear. As reserves increase, the demand curve becomes flatter until the demand for reserves is fully satiated, and the demand curve is completely horizontal. You can see this out towards the right of this chart. Here, any change in supply has no real impact on the market rate since reserves are so abundant. On the other hand, as reserves become less abundant, the demand curve becomes steeper and market rates become increasingly more responsive to changes in supply. Now that we've covered the basics, let me take a look at some options for frameworks that allow central banks to choose and set their market rate. Our supply and demand diagram shows two distinct approaches to achieving the same target market interest rate, points A and point B on this chart. At point A on the left, the central bank has set a low IOR, resulting in a low reserve demand curve, and has chosen to supply a scarce amount of reserves. With this approach, the central bank is able to create the conditions for its target market interest rate. However, in committing to a scarce reserve framework, the market rate is susceptible to volatility, given the equilibrium lies on the steep part of the demand curve. Here, even small shifts in supply and demand can result in considerable changes in the market interest rate. Alternatively, the central bank can achieve the same market interest rate at point B on the right. In this particular regime, the central bank makes use of a higher IOR, resulting in a higher demand curve, and at the same time provides an abundant level of reserves. As such demand is satiated, the demand curve is relatively flat, and there's little scope for volatility in the market rate. The consequence of the central bank's choices is twofold. It has chosen to remunerate reserves at a higher IOR, and consistent with that, it provides more reserves. The examples I've used, A and B, are relative extremes in regimes where central banks aim to set supply and influence demand. In theory, the central bank can achieve the same market interest rate using a plethora of combinations of reserve supply and IOR. For this reason, we see a variety of different frameworks implemented at different times in the real world. Prior to the global financial crisis, reserves were generally scarcer, and central banks used regular open market operations to fine-tune the supply of reserves to keep short-term money market rates aligned with the policy rate. Within these systems, market rates fluctuated within a corridor, with facilities setting the floors, as defined by the IORs in this chart, and ceilings for rates. The sharp economic downturn accompanying the global financial crisis necessitated a historic reduction in interest rates, and most major central banks quickly approached their effective lower bounds. As a result, many central banks engaged in large-scale asset purchases, primarily government bonds known as QE. To pay for these assets, central banks created reserves. These reserves became liabilities on the central bank balance sheet, mirroring the newly acquired assets as illustrated in this stylized central bank balance sheet here. Again, this is a stylized central bank balance sheet. It's not exhaustive, and the things on the right don't necessarily back the things on the left. But what's key to know is that in the process of QE, as central banks bought government bonds, they significantly increased bank reserves. As reserves became abundant, this pushed market rates lower. In order to effectively implement monetary policy, the policy rate acted as a floor to and target for market rates, and we entered a decade where central banks used these floor systems. The forceful actions taken by central banks in response to COVID expanded their balance sheets even further, reaching historically elevated levels. You can see this in this chart going back to the 1600s for the UK. It's just the evolution of the balance sheet. You can see towards the right of this chart, massive increase, and subsequent, you can see there's some decrease here as well. That represents the decrease, represents the QT that the Bank of England has undergone following COVID. There are a number of benefits to shrinking the balance sheet. For example, it reduces the risk of balance sheet ratcheting higher in size and increases the headroom for central banks to be able to use its balance sheet in the future if needed to in support of its remit. Most central banks have been shrinking their balance sheets through passive roll-off, so allowing assets to come to maturity without reinvesting all of it. But the Bank of England has also engaged in active sales. This is largely because the UK government bonds we purchased had on average a longer maturity than our peers. So unwinding the balance sheet by relying on passive roll-off alone would have taken much longer. Passive roll-off would also have involved a really lumpy profile of sales. So active QT has allowed us to smoothen this out a bit. This move away from an abundant reserves environment, which has been the status quo for over a decade, represents a significant transition for central banks. And as with any transition, it carries some risk. As we get closer to the minimum level of reserves required by commercial banks, known at the Bank of England as the preferred minimum range of reserves, or the PMRR, central banks have laid out their plans for what their respective steady state frameworks will look like. As mentioned, there's a whole range of frameworks between abundant and scarce reserves that can, in theory, all ensure effective interest rate control. But there are two main considerations central banks need to take into account when determining the likely end state for their balance sheets. First, we can't actually observe the PMRR. So while we have estimates for where it might be, they're uncertain and the number changes over time. Second, policymakers will need to ensure a new monetary framework that does not jeopardize financial stability objectives. In practice, this means not going back too far to the left in this chart, which was a supply and demand chart, into the territory of scarce reserves. Put together, the optimal framework is likely to have ample reserves, but less abundant than the levels observed in the period right after QE. With some theory under our belts now, I'd like to explore how central banks have been transitioning to their new steady states and what steady state frameworks they've chosen. I'll focus again on these three major central banks, the Bank of England, the ECB, and the Fed. This table here is a cheat sheet for what the new steady states look like for these central banks. As you can see, the Bank of England and the ECB have chosen relatively similar steady state frameworks with a demand-driven floor, while the Fed has opted for a supply-driven framework. I'll briefly outline each of these frameworks in turn and how they can ultimately help to achieve similar interest rate outcomes, starting with the Bank of England's. The bank has been passively unwinding its balance sheet since early 2022 before actively selling gilts later that year. As reserves become scarcer, the risk of volatility in short-term market rates rises, as I've outlined already. To avoid this, the bank introduced the short-term repo facility, the STR. This repo facility allows commercial banks to borrow an unlimited amount of reserves at bank rate for a 7-day term. In exchange, they have to offer up high-quality collateral such as gilts. This facility ensures that the money market rates do not rise too far above bank rate, since banks could then borrow reserves at cheaper rates from the Bank of England than in the market. Another repo facility, the Index Long-Term Repo Facility, or ILTR, will play an increasing role to complement the STR in providing reserves. In practice, this requires operational readiness of the bank and of commercial banks to ensure these facilities are used effectively and seamlessly. Indeed, the increasing usage of repo facilities over the past year, which you can see in the chart on the left, coincides with money market rates having stayed relatively close to bank rate, as is shown in the chart on the right. And that goes some way to demonstrating this case. The chart on the right, by the way, is looking at the spread between SONIA and bank rate. And so you can see back in 2002, we had a totally different system. There was much more volatility. More recently, there's been much less volatility. So the spread has been much smaller. As QT reduces reserves, the bank expects a growing share of reserves to be backed by its repo operations. Once reserves fall to the level of banks' true demand, the so-called PMRR, we expect banks in aggregate to replace any reserves lost due to the unwinding of QE and TFSME, an emergency lending program, by participating in our repo operations. At that point, the aggregate quantity of reserves will be repo-led and demand-driven. The bank's regular repo facilities will help to ensure short-term market interest rates remain aligned to bank rate, maintaining the effective transmission of monetary policy. The ECB began shrinking its balance sheet a bit later in 2023, but the pace has been pretty swift. You can see that in this chart, looking at the evolution of the ECB's balance sheet since 2018. The ECB has taken a passive approach to QT, allowing expiring holdings to roll off across its various QE portfolios. Despite these reductions in the ECB's QT portfolios, the majority of the roll-off of the balance sheet has stemmed from repayments of the ECB's TLTROs, or targeted long-term refinancing operations, as you can see in the chart. That's the purple, so they've come down the most. In order to keep control of money market rates, the ECB aims to transition to a demand-driven system with a soft floor in steady state. Within this framework, in a similar spirit to the bank, the ECB uses a variety of facilities to keep money market rates anchored to its target rate, which is the deposit rate, including the main refinancing operations, or MROs, and marginal lending facility, or MLF. You can see these all in the chart on the left here. So the DFR is the deposit rate, that's the policy rate. The MRO and the MLF are facilities used to keep short-term money market rates close to the deposit rate. And in the chart on the right, again, this is looking at the spread between unsecured lending and the policy rate here, which, at 8-ish basis points is pretty small. What differentiates the ECB system from the bank's steady state demand-driven framework is the pricing of standing weekly repo facilities. The ECB prices both its short-term and long-term repo facilities at the same rate, currently 15 basis points above the deposit rate, and the pricing doesn't depend on the collateral posted. In contrast, the Bank of England prices its short-term repo operation at the policy rate with a haircut applied to collateral, but allows the price of a longer-term repo facility, the ILTR, to set higher depending on how much participants bid and what collateral they post. Shifting on to the Fed was the first among these major central banks to undergo QT starting in 2017, but this was halted after a spike in the repo rate in 2019. The current round of normalization began in 2022, though the pace of passive unwind has more recently been adjusted lower as the Fed approaches the level of reserves it intends to supply in its supply-driven framework. As the Fed's security holdings, which you can see in the aqua here, declined, the overnight reverse repo has accounted for the bulk of this shrinkage, so that's the orange. Unsurprisingly, this is the case given they are the most rate-sensitive funds, and the overnight reverse repo facility is intended as a backstop tool. Unlike the Bank of England and the ECB, which target policy rates, the Fed explicitly specifies a target range rather than a single rate known as the effective Fed funds rate. To keep the effective Fed funds rate here in aqua in the chart on the left, within a controlled channel, the Fed uses interest on reserve balances, IORB, to act as a floor for market rates. But as you can see, the effective Fed fund rate has been below IORB for much of this period. That's because liquidity has increased to significant levels, as you can see in the spread in the chart on the right between the EFFR and IORB. This is often attributed to the presence of significant lenders who can't park reserves at the central bank and so are willing to lend reserves at a lower rate than the IORB. To reinforce the IORB as a floor, the Fed introduced the overnight reverse repo, which is at a slightly lower rate. This effectively acts as a backstop to ensure that rates don't fall too far below the IORB in periods when there is excessive liquidity. This corridor between IORB and overnight reverse repo rates allows the Fed to manage day-to-day fluctuations in the Fed funds market. Finally, the Fed uses a standing repo facility to supply liquidity to prevent market rates going too high, effectively acting as a cap of sorts as institutions can borrow cash from the Fed at that rate. Banks can also access liquidity from the Fed at the discount window, though use of this facility has a stigma attached to it. You can see in this chart on the right that the spread between the effective Fed funds rate and IORB has remained pretty small and steady in recent years. In steady state, the Fed aims to supply an ample level of reserves, somewhere between an abundant level of reserves and the level demanded by counterparties. Reserves supplied above what the system needs implies that the Fed will remain on the relatively flat part of the reserves demand curve in this figure. In theory, this means money market rates should be within the FOMC's target range without the need for regular use of central bank liquidity facilities to actively manage reserve supply. Still, the standing repo facility and discount window are in place as a release valve for when there are pockets of illiquidity in the markets. This is different from the Bank of England and the ECB, for which these ceiling tools are intended to be used for regular liquidity management. So far, I've discussed the different approaches to balance sheet normalization being taken by the Bank of England, the ECB, and the Fed. In steady state, these major central banks will offer lending facilities to market participants that operate differently. A natural question, therefore, is whether this generates price differentials across markets that create trading opportunities for global banks operating in all of these jurisdictions. I'm referring to these opportunities here as arbitrage. If there are arbitrage opportunities, do I need to care as a member of the MPC? Does this have implications for monetary policy implementation? In short, the scope for arbitrage exists, but appears limited. Most importantly, it doesn't undermine monetary policy implementation, but rather strengthens it. I'll begin by considering why one might think the transition away from abundant reserves to new regimes might bring more arbitrage opportunities. First, there are more tools and facilities being introduced by central banks and demand-driven systems. In these systems, banks operating in different jurisdictions will need to directly access facilities operated by multiple central banks. And these will have differing prices and eligibility requirements. This may in turn create opportunities for some form of arbitrage. For example, the Bank of England and the ECB both intend for their market-wide repo facilities to be used as part of regular liquidity management, but they're priced differently. The Bank of England's STR is priced at bank rate with an estimated all-in cost of around 5 to 10 basis points above bank rate once you account for the cost of haircuts on collateral. While its longer-term facilities has pricing that will vary according to demand. The ECB prices both its short and long-term repo at 15 basis points above the deposit rate and with different collateral eligibility to the Bank of England's. These discrepancies in pricing could, in theory, create an opportunity for global banks present in both markets to benefit through trades, making use of multiple central bank facilities. The potential for these mismatches may also be higher since there's likely to be greater volatility in money market rates, given liquidity needs will need to be more actively managed rather than satiated by an abundance of reserves. Second, different choices and frameworks for managing money market rates will also result in differences in pricing. Once all systems are in steady state, the theory would suggest that we're likely to see short-term market rates as a spread to the policy rate settled differently depending on whether the supply of reserves is lower or higher. And that's shown in this stylized supply and demand chart here. You can see that this is illustrated at points A and B, which shows that for a given set of assumptions, the IOR set by central banks would be higher relative to the policy rate in a system with more abundant reserves, so that's B, versus one with less abundant reserves. A global bank could, at face value, trade fluctuations in the differential between these two spreads created by different systems. For example, if there were a shock causing euro area money market rates to fall significantly below the ECB's deposit rate, a tactical arbitrage opportunity could arise. The bank could borrow at the more favorable euro area money market rate, convert this into sterling via FX swaps, hedge the FX market risk, and then place this money into a reserves account at the Bank of England to earn interest at bank rate. These are some of the ways in which arbitrage opportunities might emerge. Now I'll lay out why, both in theory and in practice, these opportunities for arbitrage are not new, per se, will likely be limited in scope, and actually act as a feature in supporting rate control. Arbitrage is an intrinsic and essential part of financial markets generally. It's what ensures assets are priced fairly and efficiently. And while frictions like forms of regulation or transaction costs mean that prices of assets may not perfectly adjust to what might be considered their fair value instantaneously, financial markets are generally effective at correcting what might be considered mispricing over the medium term. Opportunities for arbitrage exist across all asset classes, and also across central bank facilities. This could be one reason hedge funds have played an increasingly prominent role in QE and QT auctions in the UK as they intermediate secondary bond markets, a trend that's visible across all major sovereign bond markets. I also know that firms have always benefited from different pricing across jurisdictions, including in the recent period of abundant reserves. After all, they can earn interest by holding reserves at central banks. So global banks have an incentive to move cash to take profits on their location whenever a profitable FX basis arises between sterling, the dollar, and the euro. If it's profitable to shift money across jurisdictions, once accounting for the cost of exchanging and hedging the currencies and other constraints, banks will do so. It's very difficult to disentangle this in the data and provide evidence, but we should assume that if banks have an opportunity to make an attractive risk-adjusted return, they're likely to embrace it. Still, opportunities for arbitrage are limited. If pricing differentials create opportunities across jurisdictions that lead to firms swapping currencies to take advantage of this, one would expect exchange rate markets to adjust and remove this opportunity. In essence, this is macro 101. Exchange rates adjust to remove the potential for arbitrage, known as the covered interest rate parity condition. If it were still profitable for a bank to take advantage of pricing in another jurisdiction's central bank facilities, even after accounting for exchange rate differentials, then one would expect the relative cost of borrowing and lending currencies, known as cross-currency basis, to adjust and act as a secondary means of absorbing any return. Admittedly, frictions and regulatory frameworks in these markets may prevent this adjustment from being immediate or full, but they should reduce the opportunity for arbitrage and ensure that deviations of exchange rates from the standard framework are temporary and therefore not relevant for me as a monetary policymaker with a medium time horizon. Nuances underlying the headline pricing of different central bank facilities may also limit the scope of arbitrage. For instance, the different haircuts applied to collateral used in these facilities may outweigh the differences in the effective cost of using different facilities. And looking ahead, it's also worth noting that the pricing of and eligibility for these facilities could change in the future. After all, the current pricing is calibrated to the current state of transition and could change once central banks reach their desired steady state. Indeed, as my colleague Vicky Supporter recently set out in a speech, central banks are likely to be learning by doing. Therefore, the scope and magnitude for arbitrage opportunities might change in the future. And finally, the willingness of banks to identify and act on pricing differentials is a feature of our system, not a bug. After all, the usage of our facilities, whether it be for arbitrage opportunities or for other liquidity purposes, is crucial for controlling rates in short-term money markets and ensuring that they don't drift too far from the policy rate. Floor and corridor systems only work because central bank facilities provide incentives for banks to participate in them as part of the money market. And the presence of arbitrage opportunities can provide one such incentive. This control of short-term rates is essential in ensuring the transmission of monetary policy is not distorted and can be used effectively to ensure price stability, which is my primary objective as an MPC member. This is especially important in the current context since it ensures that we can continue to undergo QT without the risk of losing monetary control on the way to and through the PMRR. The recent experience in the UK provides me with additional confidence that monetary policy implementation should be unaffected by this going forward. After all, there's been a welcome reduction in stigma associated with these facilities and a pickup in their usage, as I showed in a chart previously. Our facilities are very much open for business. Money market rates have been relatively contained with limited volatility and no obvious distortions in relative pricing across jurisdictions. All of this leaves me with a space to focus on being able to set monetary policy, which is all the better since there's plenty to think about on that front at the moment too. I thought I'd finish up just by laying out some of my monetary policy views. There's a significant amount of uncertainty both domestically and globally. And so at the Bank of England, we use scenarios to help us think through risks around our outlook. I'd just like to take a few minutes to discuss what I think the key risks are. The main messages for me remain the same. Underlying activity is weak, the labor market has loosened further, and the disinflationary process continues, albeit with an elevated plateau of inflation around 3.5% for the second half of this year. I'm worried about both the demand and the supply sides of the economy. On the demand side, we assume a recovery in output to nearly 2% over the forecast period, driven by a pickup in consumption and a corresponding fall in the savings ratio. I'm not sure this will materialize. as I set out in a previous speech, mortgages resetting at higher rates are likely to continue to weigh on consumption, even as interest rates are on a downward trajectory. And I expect precautionary savings will rise, not drop, as the labor market softens further. All else equal, this would be disinflationary. On the supply side, both headline and underlying productivity growth have fallen considerably. We expect a sharp recovery in productivity growth over the forecast period, almost back to the 1% trend. I believe the risks to this are firmly on the downside. This could be exacerbated by recent trade policy developments. Trade policy uncertainty is likely to remain a drag on business investment for some time to come as firms delay long-term decisions about capital allocation. Supply chain disruptions from tariffs could also serve as a negative supply shock. All else equal, these developments would be inflationary. But trade policy could be disinflationary as well. Since the Liberation Day turbulence last interest rate round, signals on trade policy have been broadly positive, including UK trade deals with the US and India, and an agreement for closer cooperation with the EU, alongside a skeleton for a US-China trade deal. Still, if countries can no longer export to the US market as profitably because of US tariffs, they might seek to drop prices for goods exports to gain access to other markets like the UK. So far, there's nascent evidence of trade diversion or rerouting from China, with goods exports volumes from China to the US falling from April 2025, but rising to the UK, EU, and particularly to ASEAN. Trade uncertainty has fallen back from April to May in line with our expectations, but I don't think realistically we have much more certainty about trade policy than we did in May. I still expect trade policy to have a net disinflationary impact on the UK economy, but it may be muted relative to my expectations in May, when it was a significant factor in my decision to cut bank rate. Meanwhile, the labor market has eased roughly in line with our expectations. A margin of slack seems to have opened up, with vacancies dropping materially in the latest print by 7.9% and the unemployment rate ticking up as we expected to 4.6%. Additionally, we saw the largest monthly fall in payrolls data in April 2025 in almost 5 years. But given the ONS's advice to view these estimates with caution, I place more weight on our own estimate of underlying employment growth, which points to stagnation in hiring rather than contraction. The corresponding picture on pay is somewhat more nuanced. So far, pay settlements have come in between 3 to 4%, in line with the steer we're taking from the agent's pay survey and DMP for this year. Overall, I think the evidence points to a slowly softening labor market rather than one that is sharply deteriorating. Finally, I worry about the near-term profile for inflation this year, which in my view now resembles more of a plateau than a hump. We expect inflation to resume its fall towards our target from early next year. However, there's a risk that elevated inflation of roughly 3.5% the rest of this year will feed through into inflation expectations and therefore wage and price setting behavior. Aside from energy and regulated prices buoying inflation, food prices have surprised consistently to the upside. Energy and food prices are particularly salient for inflation expectation setting. Household inflation expectations have been rising for months and are at the upper end of the band we might expect given consumer prices. Business expectations are also elevated, though less out of line with historical relationships. I think the risk that our near-term plateau in inflation feeds through into second-round effects is skewed to the upside. This is even more a concern in light of the escalating conflict in the Middle East, which poses upside risks to oil prices. So where does this leave me on the balance of risks? I continue to think the risks remain two-sided, but skewed to the downside on growth and to the upside on inflation. This is an uncomfortable place for a central banker to be. Given the period of elevated inflation through which we've just come, I think price stability is the key priority. But extracting a clear signal on this amongst increased noise and uncertainty is really difficult. On the domestic front, noisy data means that it will take longer for me to take comfort from recent disinflationary trends. On the global front, there are a number of key events playing out between now and our next interest rate decision, including the deadline for the pause on so-called reciprocal tariffs from the US, the potential passage of a budget in the US, and the unfolding of events in the Middle East. It's unlikely that the uncertainty from these events and subsequent developments will be resolved anytime soon. I therefore think a careful and gradual approach to removing monetary policy restrictiveness continues to be warranted. I'll leave it there and look forward to your questions. Thanks.
Thank you so much for that talk. I feel I now know lots more about how monetary policy actually works and will be working in the future, so that's good. I'm going to take questions in groups of 3. For those of you online, please put your question into the chat. For those of you in the room, if you want to put your hand up, and when I come to you, please tell me your name and who you're representing. That would be great. I'm going to go straight to David and then.
Thank you, David Robertson, Market News. I just wonder if your view of the bank balance sheet isn't a little Panglossian. On QT, you're saying it's all fine, it goes ahead, repos will take account of it, the enhanced repos. In reality, the bank's already postponed one long-term 30-year auction. You're supplying debt into a market that already has a very high supply. Unlike, say, the Riksbank, which is buying debt into a market that has low supply. There are signs of stress and strains. The long end of the curve is a bit of a mess. Isn't it a little bit overly rosy, the explanation you're giving here?
Okay, we'll take the question from that gentleman over there.
Greene, University of Cambridge. I would like to ask 2 slightly technical questions about this supply and demand curve that has featured prominently. I noticed that the position of the IOR1 and IOR2 are not in the same kind of place, right? So the 2 are little thing here, which is basically IOR1 is where the A curve will steady on. But IOR2, the B curve will actually go underneath. That's my first question. So it's really the IOR1 and IOR2 curves may have different nature. Secondly, how much does it rise? Does the rise of an IOR is needed to make the difference between the 2 curves? Thank you.
Thank you. If you'd like to have a crack at those 2.
Sure. Am I too rosy? I would say no, obviously. But just to address a few of the details of your preamble. On the QT operations, which were switched, so we had a long-term operation that was meant to go ahead beginning of April, that we swapped with another one, with a shorter-term one, just out of an abundance of caution, given the volatility that we saw in markets in April. That was a purely operational shift, and actually, we've just published our QT schedule, so that long-term operation is scheduled to go ahead. So that was purely an operational shift. We haven't changed the amount of QT that we're doing. We just switched 2 operations. And then you mentioned the long end of the yield curve, which has been higher. A lot of that comes from developments abroad. So in normal times, about a third of the moves in the gilt curve are driven by events happening outside the UK entirely. Since the pandemic, it's been about half. So as one sell-side analyst, I wish I could remember who it was so I could give him credit, said we're all dragged around by the drunken dragon of the treasury market. It's not just the treasury market, it's also been the the JGB market and also the Eurozone. But the UK, being a small open economy, is highly susceptible to the developments happening elsewhere. And then IOR1 and IOR2 being in different places. So I guess I'd start off just by reiterating that that's a stylized chart, so it's not meant to represent anybody's balance sheet. IOR, so the interest on reserves is set by the central bank, which influences demand for reserves. So they're meant to be in different places. It's just to illustrate that you can actually set interest on reserves differently, and then depending on the supply of reserves that you're providing, you can hit the same target interest rate. So how much of a rise in IOR is needed to change the demand curve, I guess? Is that what you're asking?
To make a difference.
To make a difference. I mean, it depends on how big a difference you want to make, right? So it could be a small change in IOR and it will have a small change in terms of the demand curve. And I should also say, for monetary policy purposes, which is my concern as an MPC member, you can hit your target market interest rate with very scarce reserves. We did it for years. It's the financial stability side of things that suggests that that's not the most resilient system.
A question there and then a question there.
Hi, thanks. Sagata Sen from Citadel. I'm just coming to your monetary policy views at the end, Megan. You spoke about the risk of inflation expectations, second round effects, emanating from the plateau, not the hump, in elevated headline inflation. You also acknowledged that the labour market is loosening further. How are you reconciling the two in your view? Is the risk from inflation expectation still there, despite potentially more slack in the labour market, or is it perhaps a more nuanced view that maybe there isn't as much slack in the labour market? Thanks.
Yeah.
Hi, Peter Morris from Rockhouse. I wanted to ask about, I suppose, the other part of the balance sheet you didn't speak about as much in your speech, which is the asset side of the bank's ongoing process of QT, which is that your colleague, Catherine Mann, about a bit under a month ago, spoke about how QT is pushing up long yields, that creates a tightening. And then as the MPC, you have a choice about whether to offset that tightening through bank rate or to slow the pace of QT. And I think I'm right in reading Catherine Mann's speech in that she led towards slowing the pace of QT because you want to target your intervention at the specific change that you want to offset, i.e. sell off in the long end. So to the extent that there is a tightening from in financial conditions from QT, how do you think the bank should offset that slowing QT or cutting bank rate more quickly?
And I have a question from Bernard.
Bernard Casey, social economic research in London and Frankfurt. You expressed uncertainty about the labour market outlooks, and that was picked up by other questions as well. Something which I had been interested in and others have been interested in is the information that we get on labour market outcomes, and hence reference to the data which comes out of the ONS. Are you developing yourselves new additional data sources to help guide you? And can you say a bit more about what are you referring to when you think things look not very good or not as bad as some people suggest? Thank you.
Sure. Okay. So Sagata, this plateau in inflation versus weakening labor market, what does that all mean for second round effects? So I think they are balanced, but not fully. So effectively, the academic literature has always suggested if inflation's under 4%, people don't notice it, so it doesn't feed through. But as it turns out, if you've had inflation above 11% in recent years, then people might be a little bit more sensitive to inflation coming up. And so it might feed through. The threshold for it feeding through into inflation expectations might be lower. We've done research suggesting that, somewhere in the 3 to 4% range is salient for households, at least in setting their inflation expectations. So if we have inflation of 3.5% now and through the rest of the year, roughly, then that falls right in that band. So it is a concern that it could feed through into wage and price setting behavior. But as you point out, the labor market is softening. So there's a question about whether households can go to their employers and say, inflation's higher, you're going to need to pay me more. Whether companies can actually do that. We're still trying to work out how firms are responding to higher employment costs as a result of the NIC. There are a bunch of different margins for adjustment. Seems like firms are using a whole host of them actually, but it does mean that whereas the last time we had inflation, a hump in inflation, the labor market was tightening, so it was clear that second round effects would kick in. This time around, the labor market's weakening, so it's less clear that even if you had inflation expectations, that could feed through into wage and price setting behavior. So for me, I'm looking at the labor market data pretty closely, at wage data really closely to try to gauge where that balance. But you're right to point out the tension. On QT and the argument that up on long yields, I already said I think a lot of factors are pushing up on long yields, some of them having absolutely nothing to do with UK, actually. But how should we offset this tightening of financial conditions Well, I will say that we look at financial conditions every single round. So insofar as you believe QT is resulting in tighter financial conditions, that's automatically an input into our interest rate decisions because we're considering that as we're making decisions. Also, we have kind of core principles of our QT program. One is that if it does tighten financial conditions, we should be able to offset that with bank rate, which is our primary tool. I do think Catherine points out that bank rate and QT affect different parts of the yield curve. So it is complicated to figure out exactly how to offset that specifically, but that is one of our guiding principles. And also if there are any kinds of market disruptions happening because of QT, we have a knockout clause quite explicitly at the Bank of England, unlike everywhere else, really, to say that we stop and revisit that if that were to occur. And then finally on the labor force surveys reliability. So it's been a challenge for us getting real visibility into what's going on in the labor market. Labor force survey response rates have gone up actually recently. So they're around 20% now versus a trough of around 13%. So that is in percentage terms quite an improvement. But, you know, the ONS itself in the last release, you know, warned against putting too much weight on some of the figures. Part of that was seasonal. But, you know, it does leave us looking at a whole host of different indicators for what's going on in the labor market. So I mentioned that I'm putting a bit more weight on our own indicator-based metric for employment growth than on what the ONS is kicking out. So we have these indicator-based models for employment and unemployment. The vacancies feed is not coming from the labor force surveys, so that tends to be a bit more reliable. And actually most of the weakening in the labor market has been coming from that side of things. So I think that is a signal that you can look at. We also look at a bunch of other data series. You know, we're looking at so-called unconventional ones that we all discovered during the pandemic when we needed more real-time data, like things like that. We're looking at RTI, the REC. So we're not just looking at the labor force survey. We have a bunch of different series that we can pull on to get a fuller picture of what's going on in the labor market.
Okay, I have Isha, I think, at the back. I have one here and one at the back.
Thank you, Suvan, for Reuters. I'm just wondering if you can spell out some of the implications of the excess of reserves, given the recent criticism from the Reform Party. Do the arbitrage opportunities for banks represent a loss or a gain in cash flows to the Bank of England? And what order of magnitude are we talking about each year? Is it single digits, billions?
Sorry, I can't really hear you. So the first question, can you just reiterate it because you lost me from there?
Sorry, I just wondered if you can sort of spell out some of the implications of the end of excess reserve, given the criticism from the Reform Party. And do the arbitrage opportunities for banks represent a loss or a gain in cash flows for the Bank of England? And what order of magnitude are we talking about each year? Is it single digits, billions, tens of, or even 100 billion? And is that something you think will average out over time or represent a transfer from the Bank of England to the ECB or Fed or vice versa? Thank you.
Question.
That's great. David Owen from Stormwash Economics. Thank you very much for this excellent speech. Just a basic question in a way on interest on reserves. Obviously, some have advocated not having those at all. I think I know the argument you're going to give, but say way would be a bad thing, would be probably quite useful. And secondly, I know the bank was trying to stress that the lenders be better prepared to actually use the longer term repo, and sort of stressing that more banks have to be prepared to actually make use of it going forward. Has that improved in your opinion? So in a year's time, more banks will be actually making use of that facility as well. Thank you.
And over there.
Hi, Catherine from BNP Paribas. It's a bit of a general question, but I just wanted to know a bit more about how the bank looks at like the pickup of the STR and the LTR as a proportion of reserves in determining the QT path.
Thank you.
Great. Sorry, I'm just making sure I got the questions. Okay, so excess reserves, and your very first question was excess reserves as they're coming down. What are the implications for what?
Yeah, and also whether they transfer to whether the arbitrage opportunities for the bank.
I got that second part. Yeah. So in terms of going from an abundant reserve system to an ample reserve system that's demand driven and repo led, effectively, I think there is a shift in where the interest rate risk lies. But beyond that, in terms of my consideration as a monetary policy committee member, our ability to ensure rate control remains pretty robust under both those systems. If commercial banks are finding financial arbitrage opportunities between different central bank facilities, is it a loss or a gain for the bank? That's not the question I would ask. I would say, does it matter for our rate control? So, I mean, effectively, our facilities work and we're able to pin the short-term money market rate close to bank rate because commercial banks participate in our facilities. So it isn't a question of money won or lost, it's just a question of whether we can actually achieve rate control. Why pay interest on reserves? Is that your question? Versus yeah, so we pay interest on reserves. So as I mentioned in my speech, banks have to hold a bunch of high quality liquid assets. Reserves are one of them, but they're not the only one, right? Gilts are also one of them. Banks get paid to hold these other assets as well. So interest on reserves also encourages them to hold some reserves, but they don't have to. They can go ahead and shift into anything else. And so by providing interest on reserves, we're able to pin down the short term of the curve. So, there's a financial stability argument as well, from my perspective, from a monetary policy perspective, it helps us maintain rate control. We want lenders to use the ILTR. We've just sort of redesigned it. My colleague, Vicky Supporter, who runs the markets desk, just came out with a speech and explanatory paper with all the details on the ILTR. I showed in one of my charts the pickup in the STR and the ILTR. The pickup in the STR has been much bigger, but now that we've redesigned the ILTR, we're seeing that pickup also increase. And that's important to us. If we're going to be a demand-driven repo-led system, we need banks to be willing to go to our repo facilities. And I think we've done a lot of work making sure that banks know this is for daily liquidity operations, it's not stigmatized. We're hoping that banks will use our facilities. We want them to, not just in times of stress, but in the course of a regular day. How are we looking at the pickup of the STR and the ILTR with respect to our decisions on QT? Is that what you're asking?
Yeah, in general, because obviously it's positive about one look at this one.
Yeah, so it's important to us that banks use them. Again, because if we're going to move to a demand-driven repo-led system, then banks really need to be using our repo facilities. If they weren't, then it would be more difficult to switch from kind of a gilt-backed reserve system to a repo-backed reserve system. So we look at it to make sure that it's happening. Certainly, consideration.
Lynn, I think we have time for one last question if there's a burning one. Right at the front.
My name is Joachim von Hallas. I'm chairman of Tuesday Club, a geoeconomic roundtable which meets frequently monthly in London. Two questions. Is the BIS, the Bank for International Settlement in Basel, do they provide any guidance with regards to balance sheets and arbitrage? And second question, most central bank meetings I'm attending, the topic CBDC, central bank digital currency, is trending upwards heavily. What's the correlation between CBDC and future balance sheets? Any views, please? Thank you.
So a couple of good questions to finish with, I think.
Yeah, so did the BIS provide guidance on balance sheets? I mean, the BIS is kind of a club for central bankers, and so it's a good forum to discuss anything in banking. In terms of the topic of my speech, I don't go to the BIS meetings, but generally they are a great forum for central banks to discuss any issues of the day.
Provide some sort of good practice
guidelines?
So the BIS has certainly put out a lot on central bank balance sheet management, that kind of thing, which you can find on their website as well.
It will be very broad and not sort
Uh,
of system.
So there are papers you can find on the internet just as well as I can. The discussions I'm not privy to. So, and then in terms of CBDCs and how that fits into balance sheet management, you know, we don't have a CBDC.
Seems to be quite a few people thinking about it.
They are, you know, as a member of the Monetary Policy Committee, my interest is the balance sheet with respect to rate control, and so CBDCs don't really play into that.
Great. Well, on that note, I'm going to have to bring everything to a close, but I'd like to thank again, Megan, for an excellent talk and some excellent questions.
Thank you.